What if I told you that for the last 20 plus years, investing in America has almost always crushed investing in Europe? While Europe gave you stability, America gave you explosive growth, while European markets moved slowly. The US market created trillion-dollar giants like Apple, Microsoft, and Nvidia. So here's the big question. Is Europe just slower? Or is America playing a completely different game? Today, we compare S&P 500 versus FTSE 100 versus DAX. And by the end of this video, you'll understand why US stocks dominate and whether that dominance will continue. Let's begin. Let's talk numbers. Over the last 15 to 20 years, the S&P 500 delivered roughly 9 to 11% annual returns. The FTSE 100 around 4 to 6%. The DAX performed better than FTSE, but still lagged long-term behind the US. Now compound that over 20 years, $10,000 in US stocks becomes life-changing money. $10,000 in European stocks, respectable, but not extraordinary. Why? It's not luck, it's structure. America doesn't just build companies. It builds platforms that dominate the planet. Look at the biggest companies in the S&P 500. Apple, Microsoft, Amazon, Google, Nvidia. Meta platforms, Tesla. These aren't just companies. They are ecosystems. They scale globally. They generate massive margins. They reinvest in R&D aggressively. Now compare that to Europe's largest companies. In the FTSE 100, oil giants, banks, consumer staples, mining companies. In the DAX, industrial manufacturers, automobiles, chemical companies. Strong? Yes. Innovative. Sometimes. Explosive growth engines. Rarely. Europe is excellent at engineering. America is excellent at disruption. And disruption creates stock market outperformance. Here's the uncomfortable truth. The S&P 500 is heavily weighted toward technology. The FTSE 100, not even close. Tech companies have higher margins, faster revenue growth, global digital scalability, asset-light models. When AI exploded, who benefited? Nvidia, Microsoft, Google, Meta. When cloud computing took over. Amazon, Microsoft. When smartphones dominated the world. Europe doesn't have global tech giants of this scale. And in the 21st century, tech drives markets. No tech dominance equals no index dominance. Simple. The US financial system is deeper. More venture capital, more IPO activity, more risk appetite. Silicon Valley funds ideas before they are profitable. Europe. More regulation, more bureaucracy, less risk-taking. When startups want to go big, many European companies list in the US because US markets reward growth more aggressively. That fuels the S&P 500 further. This part is controversial. America celebrates capitalism loudly. Europe balances capitalism with social stability. That difference affects markets. In the US, companies fire fast, pivot fast. In Europe, worker protections are stronger. Regulation is heavier. Growth sometimes slows due to policy. Is that bad? Not necessarily, but markets reward speed. True. However, when global growth happens, who captures the most upside? Usually, US tech platforms. For example, a consumer in India buys an iPhone, uses Google, orders from Amazon, posts on Meta platforms. Revenue flows back to US companies. Digital dominance compounds. Now let's calm down. Markets move in cycles. There were decades where Europe outperformed. Valuations matter. Right now, European stocks are often cheaper on PE ratios. That means lower expectations, potential for mean reversion, dividend yields often higher if tech slows. If regulation hits US giants, if AI hype fades, Europe could catch up. Always is a dangerous word in investing. US stocks outperform because innovation, dominance, tech concentration, capital market depth, risk-taking culture, global digital platforms, higher profit margins. It's a system built for exponential growth. Europe's system is built for balance. Stock markets reward imbalance. Instead of choosing sides emotionally, diversify. Understand sector composition. Watch innovation trends. Follow capital flows. If industrial revival, green energy, and value investing dominate, Europe could shine. Smart investors adapt. They don't marry a geography. So here's my question for you. Is America structurally superior for stock market returns? Or is Europe just waiting for its comeback cycle? Comment below. Team US or Team Europe? And if you want more deep, slightly controversial finance breakdowns, subscribe. Because markets don't reward emotions. They reward understanding.